It's a really strange paradox of human behavior. If you think about it, if you want to get physically fit, the fundamental truth of how to do it is almost annoyingly simple.
Right. Eat less, move more.
Exactly. You eat a little less, you move a little more, and you lift progressively heavier things over a long period of time. I mean, there is no secret.
Yeah, the blueprint is right there.
But if you look at the fitness industry, it is this multi-billion-dollar machine built entirely on the premise of complex supplements, hyper-specific workout apps, vibrating belts, and, optimization protocols.
Because you can't really monetize go for a walk and eat some broccoli.
Exactly. Complexity is profitable. Simple is just, well, simple is not. And the exact same dynamic, that deliberate, highly profitable complexity, is the foundation of Wall Street and the modern financial services industry.
It's the perfect analogy, honestly, because it gets right to the heart of the behavioral trap that we all fall into.
Oh, complete.
The financial industry basically thrives on making the average person feel fundamentally inadequate.
Yeah.
They project this aura that wealth creation requires a Bloomberg terminal, a fleet of quantitative analysts, and, a suite of complex derivatives.
Like it's rocket science.
Exactly. They want you to believe that managing your own money is akin to performing your own open heart surgery.
Yeah.
But when you actually strip away all the marketing and the noise, the mechanics of building massive, life-changing wealth are shockingly straightforward. The difficulty isn't in the math at all. It's in the psychology.
And that psychological barrier is exactly what we are unpacking today. So welcome to today's deep dive. We are looking closely at foundational philosophy that essentially birthed the modern financial independence movement.
It really did.
We're talking about the core thesis championed by J.L. Collins. Specifically, we're looking at his work in The Simple Path to Wealth.
A fantastic, truly perspective-shifting framework.
It is. And our mission today is to break down this framework, which aggressively challenges standard American financial advice. It asks a deeply uncomfortable question for, ambitious, intelligent people.
It really forces you to look in the mirror.
Right. What if the secret to building massive wealth isn't about watching the stock market all day, or picking the next NVIDIA or Tesla, or paying a high-end wealth manager?
Yeah.
What if the optimal strategy is actually doing almost nothing?
Which is profoundly counterintuitive, especially, in American corporate culture.
Oh, totally. We're wired to hustle.
Exactly. We are conditioned to equate effort with results. If you work 80 hours a week, you get the promotion.
Right.
If you study harder, you get the better grade. So naturally, we assume that to get better investment returns, we just need to apply more effort.
Read more annual reports, trade more actively.
Right. Build more complex asset allocations. But the framework we are examining today argues that in the realm of investing, this obsession with action is precisely what destroys returns.
It's wild to think about.
It is. The formula from the source material is brutally simple. Spend less than you earn, invest the surplus, and avoid debt.
Sounds easy on paper.
Right, but executing that formula over a lifetime, that requires a complete rewiring of how we perceive money and status.
Okay, let's unpack this, because that rewiring really starts with defining what wealth actually is.
Yes.
There's this story in the book that frames this perfectly. It's the parable of the monk and the minister. Have you heard this one?
I have, and it cuts right to the bone of modern consumerism.
It really does. So, two boyhood friends take entirely different paths in life. One becomes a humble monk, living a life of extreme austerity. The other becomes a wealthy, powerful minister to the king.
Dripping in status and influence, obviously.
Right, the whole 9 yards. So they cross paths years later, and the minister, in his fine robes, looks at the thin monk and feels this wave of pity.
Naturally.
And he says to him, if you could just learn to cater to the king, you wouldn't have to live on rice and beans.
And the monk's response is just brilliant.
It is. The monk looks back at him, completely unbothered, and replies, if you could learn to live on rice and beans, you wouldn't have to cater to the king.
It fundamentally flips the script on who is actually wealthy in that scenario.
It totally flips it.
It forces us to examine the modern definition of wealth. In our society, we tend to define wealth by the visibility of consumption.
The big house, the nice car.
Exactly. The size of the mortgage, the luxury car lease, the country club membership. But these are often just golden handcuffs.
Yeah, that's a great way to put it.
You might be pulling down $500,000 a year in Silicon Valley, but if your lifestyle requires $490,000 a year to maintain, you aren't wealthy.
You're just highly compensated.
Right, highly compensated but entirely dependent. Your employer ultimately owns your time and dictates your behavior. You have to cater to the king.
Wow, yeah.
The monk, however, possesses the ultimate currency, which is autonomy. True wealth isn't the ability to buy luxury, it's the ability to buy back your own time.
Which brings up this concept that gets thrown around a lot in the financial independence space, FU money. The term originally comes from a James Clavell novel,
Yeah.
but it's evolved into this really powerful psychological benchmark.
It's the cornerstone of the whole movement, really.
It is, and it's not necessarily about hitting 65 and retiring to play golf. It's about having enough liquid capital to be completely free of the demands of others. It's about having options.
Because the power dynamic in a capitalist society shifts entirely when you possess that surplus.
Alpha.
Well, without it, every minor setback is a crisis. And every toxic work environment is basically a prison sentence because you can't afford to leave.
Oh, that is so true.
But with it, you can negotiate your reality. There's this fascinating real-world application of this from the author's own life.
Oh, the Europe trip, right.
Yes, he was in his 20s, working his first professional corporate job, and he had managed to save up $5,000.
Which back then, on a $10,000 salary, was a huge deal.
Exactly. That took him 2 years of aggressive saving. But he wanted to take a few months to travel across Europe, so he went to his boss and asked for unpaid leave.
And of course, the boss immediately said no. I mean, the corporate machine doesn't just pause because a 20-something wants to go find himself in Europe.
Right. The initial response was a hard no, but because he had that $5,000 stash, his FU money, he didn't have to accept that reality.
He had leverage.
He simply said, okay, then I resign. And the moment he was willing to walk away, the leverage completely flipped.
I love that.
The boss's tune changed instantly to, wait, don't do anything rash, let me talk to the owner. He ended up negotiating a 6-week unpaid leave to ride his bike across Europe.
That is amazing.
He didn't get fired. He got what he wanted simply because he had the financial leverage to say no. That $5,000 didn't just buy a trip, it bought a shift in power.
That is the practical application of autonomy right there. But, you know, to build that kind of leverage, you have to ruthlessly eliminate the things that are draining your surplus.
Yes, the leeches.
Right? The text refers to them as leeches. And the biggest leech is debt. The stance here is uncompromising. The American norm of carrying debt, and we're talking trillions in mortgages, student loans, auto loans, it's viewed as a total wealth destroyer.
It is a vicious compounding force working in reverse.
But I want to push back on this a bit because in modern corporate finance, and even in sophisticated personal finance, we talk a lot about good debt.
Sure, the leverage argument.
Exactly. If you have a business opportunity or even just a standard mortgage, and you could borrow capital at 3 or 4%, but you can reasonably expect to invest your cash in the market and get, say, 8 or 10%, isn't it just mathematically optimal to use leverage?
It seems like a no-brainer on a spreadsheet.
Right. Why pay off a low-interest loan when you can capture that spread?
Well, in a vacuum, operating entirely on a spreadsheet, the math absolutely supports that argument. You borrow at 3, earn 8, you keep the 5% spread.
Simple math.
But human beings don't live in a spreadsheet. We live in a world of behavioral psychology, economic shocks, and job losses.
Yeah, life happens.
The argument against leverage, even low-interest leverage, is about risk mitigation and the psychological burden of owing another entity your future labor.
That's heavy when you put it like that.
When you leverage up to invest, you are introducing sequence of returns risk into your daily life. If the market drops 30% and you lose your job, that 3% debt is no longer cheap. It is an anchor threatening to pull you under.
It's the fragility it introduces into the system.
Exactly. And let's look at the most pernicious form of this, which is student loans.
Oh, don't get me started.
We have normalized encouraging 18-year-olds to take on massive non-dischargeable debt. And it's vital to understand what non-dischargeable means.
Meaning you can't just declare bankruptcy and walk away.
Right. Unlike credit card debt or a business loan, you generally cannot wipe out student loans in bankruptcy. They follow you to the grave.
It's terrifying.
The government can garnish your wages. They can even garnish your Social Security decades later. It shackles young people to jobs they hate right at the time in their lives when they should be taking massive entrepreneurial risks.
Exploring different careers, starting families, all of that gets put on hold.
Exactly. So the framework here is very strict for individuals trying to build wealth. If you have consumer debt, especially anything with an interest rate over 5%, you must treat it like a five-alarm fire. Pay it off immediately.
And the reason it's a fire brings us to the concept of opportunity cost, which, when you really internalize the math, completely changes how you view a dollar.
It ruins spending for you in the best way.
It really does. Buying a $20,000 car isn't just a matter of parting with $20,000.
No, it's parting with the compounded future value of that capital. Money isn't static, it has a trajectory.
Right.
If you take that $20,000 and invest it in a broad market index fund, historical averages suggest it has the potential to double roughly every 7 to 10 years.
Wow.
So over a 30 or 40-year investing horizon, that $20,000 could become $160,000 or even $320,000.
For a Honda Civic.
Exactly. So that car didn't cost you 20 grand. It cost you hundreds of thousands of dollars in future wealth. When you finance a car, you aren't just paying interest to a bank, you are actively financing away years of your own retirement.
Which is a very sobering way to look at it. Because if your lifestyle exactly matches your income, even if it's a really high income, you are essentially what Collins calls a gilded slave.
The chains might be made of gold, but they are still chains.
Exactly. The goal here is aggressive capital accumulation, pushing toward a 50% savings rate.
Which sounds impossible to most people.
It does. But if you are saving half your income, the math is beautiful. Every year you work buys you a year of freedom.
But accumulating that surplus is only the first half of the equation.
Right, you can't just stuff it in a mattress.
A pile of cash sitting in a bank account is being slowly eroded by inflation. You have to deploy that capital. You have to invest the surplus. And this is where intelligent, highly educated people get completely lost in the labyrinth of Wall Street.
Yes, the illusion of control. This is fascinating to me because it taps into the ego of the ambitious professional.
It really does.
We want to believe that if we read the annual reports, study the macroeconomic trends, watch the financial networks, and analyze the charts, we can pick the winning stocks.
We want to outsmart the system.
Exactly. We think we're the exception. But the data shows this is a catastrophic psychological failure.
It is a failure driven by two primal human emotions, fear and greed.
Always comes back to those two.
Humans are psychologically hardwired to be terrible at stock picking. Daniel Kahneman's work in behavioral economics, specifically prospect theory, shows that the pain of losing money is psychologically twice as intense as the joy of making money.
So we act irrationally.
Exactly. So what happens? When the market is soaring, FOMO, fear of missing out, takes over, greed kicks in, and retail investors buy in at the absolute peak.
Right. When everyone at a cocktail party is talking about a stock, you buy it.
And then, when the market inevitably corrects and drops 20%, loss aversion triggers sheer panic and they sell at the bottom. We systematically buy high and sell low, acting entirely on instinct.
But wait, here's where it gets really interesting. Surely, if you take the emotion out of it, a smart person who does the research can beat the market, right?
You would think so.
I mean, we see actively managed mutual funds everywhere. There are entire networks dedicating 24 hours a day to stock analysis.
And thousands of highly compensated portfolio managers.
Exactly. Some of them must be consistently beating the index.
Oh, this is the ultimate hubris of the active investor. You have to ask yourself, who is on the other side of your trade?
Oh, that's a good point.
When you decide to buy a stock because you think it's undervalued, who is selling it to you? You are competing against professional institutional analysts who have Bloomberg terminals, algorithmic trading bots executing in microseconds, and entire teams of people working 80-hour weeks dedicated to analyzing this specific sector.
You're bringing a knife to a gunfight.
Exactly. And here is the profound punchline of the data. Even those highly paid professionals fail.
The numbers on this are just devastating to the active management industry.
They really are.
The text cites this massive Vanguard study from 2013 looking at actively managed funds. And get this, over a 15-year period, 82% of actively managed funds failed to beat their unmanaged benchmark index.
And if you stretch the time horizon, it gets statistically absurd.
What do you mean?
Well, if we connect this to the bigger picture, there's a landmark study by professors Burrus, Scale, and Vermers. It was published in the Journal of Finance.
Okay.
They looked at the performance of over 2,000 actively managed mutual funds over a 30-year period.
30 years, so a really solid sample size.
Right. They wanted to see how many portfolio managers possessed true, statistically significant skill in beating the market rather than just getting lucky.
And what did they find?
The result, only 0.6% showed any actual skill.
Wait, 0.6%?
Less than 1%. That is statistically indistinguishable from zero.
That is insane.
Mm.
So 99.4% of the time, these highly credentialed, highly compensated Wall Street professionals are either just mathematically lucky for a brief period, or they are actively underperforming a brainless index.
Precisely. And this begs the question, if active management doesn't work, why is it a multi-trillion-dollar industry?
Yeah, why does it even exist?
Why are these funds pushed so heavily by financial advisors?
So because of the fees?
Always the fees. Wall Street doesn't create complex, actively managed products because they generate higher returns for the client. They create them because they justify a 1% or 2% management fee.
Right, because you have to pay the experts.
Exactly. That fee is extracted every single year, regardless of whether the fund goes up or down. The complexity is profitable for the creator, not the consumer. The house always wins.
You know, it's telling that even Warren Buffett, arguably the single greatest stock picker in the history of capitalism, explicitly tells everyday investors not to play his game.
It's incredibly telling.
When he outlined the instructions for his wife's trust after he passes away, his directive wasn't to hire a team of elite Berkshire Hathaway analysts to find undervalued companies.
No, not at all.
His directive was to put 10% in short-term government bonds and 90% in a very low-cost S&P 500 index fund. The greatest active manager alive says the optimal strategy for almost everyone is passive indexing.
Because Buffett understands friction.
Right.
He understands that retail investors trying to pick stocks are dealing with trading costs, tax drag, and most importantly, their own behavioral flaws.
Oh, the behavioral flaws will get you every time.
Collins himself shares a painful anecdote about this. Early in his investing life, he thought he could outsmart the market.
Like we all do.
Exactly.
Yeah.
He invested heavily in a gold mining penny stock called Mariah International. He swung for the fences trying to find that one 10x winner, and he lost $50,000.
Ouch. 50 grand.
It was a brutal, expensive lesson in the reality of stock picking.
Yet the financial industry continually reinvents the narrative to justify active trading. There's this fascinating debate highlighted in the text regarding the adaptive markets hypothesis.
Yes.
This is championed by highly credentialed economists who argue that because modern markets are faster, more algorithmic, and more volatile, the old strategy of simply buying and holding an index is dead.
Right. They say the game has changed.
Exactly. They argue you need a hyper-complex portfolio of commodities, currencies, international equities, varying bond durations, and you need to actively trade between them to avoid volatility.
And Collins' response to this sophisticated economic theory is essentially, you're treating the wrong disease.
How so?
The economist is trying to build an insanely complicated, fee-heavy portfolio to treat the symptoms of human panic.
Trying to create a smooth ride.
Exactly. They are trying to engineer a portfolio that never goes down so the investor never gets scared. But Collins argues that instead of engineering away the volatility, you should toughen up Cupcake and fix your own psychological fragility.
Huh. Toughen up Cupcake. I love that.
You accept that crashes happen. You accept the volatility as the price of admission. Instead of complex allocation, you master your own fear.
So stop trying to pick the next Apple. Stop trying to short the next blockbuster. Recognize that you are not Warren Buffett, and frankly, you don't need to be.
Right.
There's this strange paradox where if you accept what sounds like an insult, settling for average market returns by buying the index, the compounding math guarantees that over a 30-year period, you will actually outperform the vast majority of all professional and amateur investors.
By mathematically guaranteeing you will never beat the market, you ensure you will beat almost everyone else.
Which brings us perfectly to the mechanics of how we actually capture that average.
The engine itself.
Right. If we aren't picking stocks, what is the actual engine of wealth? The core argument here is that the stock market is not a casino. Over the long term, it is essentially a proxy for human progress, innovation, and economic growth.
Yes, the upward trajectory of humanity.
And despite world wars, Great Depressions, recessions, and global pandemics, over a long enough timeline, the market always goes up.
It's a bold claim, but it is supported by over a century of empirical data.
The numbers don't lie.
And the specific tool recommended to capture this upward trajectory is VTSAX. That's the Vanguard Total Stock Market Index Fund. By purchasing a single share of this fund, you are instantly buying a tiny fractional ownership stake in roughly 3,700 publicly traded companies in the United States.
You own a piece of everything.
Exactly. You own a piece of Apple, Amazon, Exxon, Walmart, and thousands of smaller companies you've never even heard of.
And it's really worth pausing here to explain why Vanguard specifically is highlighted. Because the corporate structure of Vanguard is entirely unique in the financial industry.
Completely unique.
It was founded by Jack Bogle, who essentially invented the retail index fund. But the real revolution wasn't just the index, it was the ownership structure.
Exactly. Most investment firms like Fidelity or Charles Schwab are either publicly traded companies or privately owned by billionaires.
Wow.
Their fundamental fiduciary duty is to generate a profit for their shareholders or owners. And how do they do that? By charging you, the investor, fees.
Taking a slice of the pie.
But Vanguard is structured as a mutual company. It is owned by the individual funds themselves, which means it is owned by the investors in those funds.
Wait, so the investors own the funds and the funds own Vanguard?
Exactly. It operates at cost. There is no outside group of shareholders demanding a profit margin be extracted from your retirement savings. That structural difference is why their expense ratios are so incredibly low.
That is wild. But let's dig into the mechanics of the index itself. When people hear they are buying 3,700 companies, a common reaction is fear of the loser.
Oh,
People say, I don't want to own 3,700 companies. What if I own a huge chunk of General Motors right before it files for bankruptcy? Or Sears? Won't those failing companies drag my wealth down?
This is where we need to explain how market cap weighting works, because it is the secret sauce of the index.
Okay, break that down for us.
Market capitalization is simply the total value of a company's shares. Apple is worth trillions, so it represents a massive slice of the VTSAX pie.
Makes sense.
If a company starts failing, say, a legacy retailer losing ground to e-commerce, its stock price drops. As its price drops, its market cap shrinks. Therefore, it automatically takes up a smaller and smaller percentage of the index.
Oh, so it just naturally fades away.
Exactly. You don't have to hire an analyst to realize the company is dying and sell the stock. The mathematics of the market do it for you. It is a self-cleansing mechanism.
Self-cleansing.
By the time a company actually goes bankrupt, it represents a microscopic fraction of a penny in your portfolio. It just falls off the bottom.
And the inverse is where the real explosive growth happens, right? When a new star rises, an Amazon in the early 2000s, or a Tesla or Nvidia more recently, as its stock price climbs, it automatically takes up a larger percentage of your portfolio.
You capture all the upside.
You don't have to guess who the winner of the AI revolution will be. You automatically own all the competitors, and the winner naturally rises to the top of your holdings.
And this highlights the ultimate mathematical asymmetry of the stock market.
Which is?
Well, if you own a terrible company, what is the absolute worst that can happen? The stock drops 100%. It goes to zero.
You lose your investment.
You lose the capital you invested in that specific company. But what is the upside of a great company? A stock can grow 1,000%, 10,000%, 50,000%.
There's no ceiling.
There is no mathematical ceiling on human innovation and corporate earnings, so the infinite upside of the winners heavily outweighs the capped 100% loss of the losers. That asymmetry pulls the entire index upward over time.
There's this brilliant analogy used to explain this in the book, The Mug of Beer.
Oh, I love the beer analogy.
Mr. Money Mustache actually highlights this in his foreword to the book. If you look at a large glass of poured beer, there is a thick layer of foam on top.
Right.
That foam represents the unpredictable daily volatility of the market. It's the noisy stuff on CNBC. It's algorithmic flash crashes, political tweets, trade wars, and short-term earnings misses. The foam bubbles up, it shrinks down. It's chaotic.
But underneath the foam is the actual beer.
The good stuff.
The liquid. That represents the real underlying growing value of American businesses producing goods, generating services, and distributing dividends.
Yeah.
The mistake retail investors make is that they spend their entire lives trading the foam, trying to guess what the noise will do tomorrow. But as index investors, we ignore the foam entirely. We are just buying the beer and letting it slowly fill the glass over decades.
But let's be intellectually honest here and address the elephant in the room. The big ugly event?
The crashes.
The catastrophic market crash. I mean, we lived through the 2008 global financial crisis,
Hmm.
where the market dropped over 50%.
Hmm.
We saw the violent, terrifying speed of the March 2020 pandemic crash.
Scary times.
If you were holding 100% VTSAX, you were taking the entire hit right on the chin. How do you psychologically survive watching half your net worth vaporize in a matter of months?
The framework completely flips how you are supposed to perceive a crash. The advice is entirely counterintuitive.
Okay, what is it?
If you are in the wealth accumulation phase of your life, meaning you're working, earning a salary, and actively investing your surplus, a market crash is not a tragedy. It is a massive opportunity. It should be celebrated.
Celebrated.
Yes. When the market drops 50%, it means the entire American economic engine just went on a 50% off clearance sale.
Stocks on sale.
Every dollar you invest that month buys twice as many shares, which will compound massively during the inevitable recovery.
But the instinct is to jump out. People want to sell to stop the bleeding, wait for the dust to settle, and buy back in when things are safe.
Which is market timing, and it is universally fatal to returns.
Because you never know when it's safe.
Because the market does not announce when the bottom has been reached. Historically, the most explosive days of market recovery happen immediately after the most terrifying days of a crash.
You blink and you miss it.
If you jump out of the roller coaster to avoid the dip, you inevitably miss the violent upward swing of the recovery. You lock in your temporary losses and make them permanent. The price of admission for long-term wealth is accepting the volatility.
So the strategy is simple, but the execution requires absolute iron discipline. Naturally leads us to the question of managing risk over a lifetime.
Right, because circumstances change.
Because taking a 50% hit when you are 30 years old and working is one thing. Taking a 50% hit the year after you retire is something else entirely. We need to navigate financial life stages.
Right. The traditional financial advisory industry uses a very rigid age-based formula for this.
The 100 minus your age rule.
Exactly. They typically tell you to subtract your age from 100, and that should be your percentage of stocks, with the rest in bonds. So a 40-year-old should be 60% stocks, 40% bonds. A 60-year-old should be 40% stocks, 60% bonds. It's an automatic glide path to conservatism.
But Collins rejects this age-based formula entirely because life stages in the modern economy are incredibly fluid. You aren't defined by your birth year.
No, not at all anymore.
In the FIRE community financial independence, retire early, you might reach financial independence at 35, or you might work until you're 50, take a 3-year sabbatical to sail around the world, and then go back to consulting at 55.
People's careers aren't linear.
Right. Your asset allocation shouldn't be tethered to an arbitrary birth date. It needs to be tethered to whether you are accumulating capital or preserving it.
Exactly. He divides our financial lives into two distinct phases. The first is the wealth accumulation stage. Okay.
This is when you have earned income from a job or business, and you are generating a surplus. During this phase, his advice is fiercely aggressive. 100% equities. 100% VTSAX. You put all your eggs in the basket of American business and you don't look at it.
Which gives traditional wealth managers a heart attack. They argue you need bonds to smooth the ride.
But during the accumulation phase, you don't need a smooth ride.
Right.
Your paycheck is your shock absorber. If the market drops 40%, it doesn't affect your ability to buy groceries because you are living off your earned income.
You're not selling shares to eat.
Exactly. Holding bonds during your accumulation phase acts as a massive drag on the compounding growth of your wealth. You are paying a premium for a safety net you don't actually need yet.
However, when you transition to the wealth preservation stage, meaning you step away from mandatory work and you are now relying on your portfolio to pay for your groceries and your mortgage, that is when the math changes. That is when you introduce bonds, specifically a broad bond index like VBTLX, the Vanguard Total Bond Market Index Fund. The suggested allocation shifts to something like 75% stocks and 25% bonds.
Okay.
The bonds are there to serve a very specific mechanical purpose.
Let's explain that mechanism, because people often misunderstand bonds. They think of them just as save money, earning a little yield. But how do they actually function in a portfolio during an economic crisis?
Bonds act as a deflationary hedge and a behavioral shock absorber.
Break that down.
When a severe economic crisis hits, say, a massive recession, central banks typically slash interest rates to stimulate the economy. There is an inverse mechanical relationship between bond yields and bond prices.
So when rates go down?
When interest rates drop, the value of existing bonds with higher yields goes up. So while the stock portion of your portfolio is cratering, the bond portion is often holding steady or actually increasing in value.
Oh, that makes sense.
This gives you a pool of stable capital to draw your living expenses from, so you don't have to sell your stocks at absolute rock bottom prices. It protects you from sequence of returns risk.
That makes perfect sense for preservation.
Yeah.
But it brings up a massive, highly debated behavioral question in the investing world.
Windfall question.
Yes. Let's say you are transitioning, or maybe you just receive a windfall. You sell a business, you sell a house, or you receive a $120,000 inheritance. You have this lump sum of cash. How do you deploy it into the market?
Right.
Do you dump it all in on a Tuesday, a lump sum investment, or do you use dollar cost averaging?
Dollar cost averaging, or DCA, is the practice of spreading that investment out over time. Taking that $120,000 and investing $10,000 a month for 12 months. It is the default recommendation of almost every financial advisor because it supposedly reduces risk.
And psychologically, I have to admit, I struggle with this. If I have a massive windfall, throwing it all into the market at once feels reckless. I'm terrified the market will crash the very next day. My survival instinct screams at me to trickle it in slowly. Why does this framework argue that my instinct is dead wrong?
Because what's fascinating here is that DCA is fundamentally market timing in disguise.
Market timing.
Yes, driven entirely by loss aversion. Let's look at the math. Historically, the stock market goes up approximately 77% of the time on an annual basis. It has a positive expected return.
Okay.
When you hold your cash on the sidelines and slowly trickle it in, you are betting against the historical trend. 77% of the time, the market is rising while your cash is sitting there, which means every subsequent month you are just buying the exact same VTSAX shares at a higher and higher price. You are dragging down your overall return.
So, by choosing DCA, I am willingly paying a mathematical penalty just to soothe my own emotional anxiety.
Exactly. You are paying an insurance premium for emotional comfort. Now, if investing a lump sum will genuinely cause you to lose sleep, panic, and sell everything at the first sign of a dip, then yes, DCA is better than not investing at all.
Know yourself.
Right. But mathematically, lump sum beats DCA the vast majority of the time. The market is a machine that transfers wealth from the fearful to the patient.
And speaking of emotional comfort, what if someone is listening to this and thinking, I understand the math, but I know myself. I simply do not have the iron stomach to hold 100% stocks during a recession. I will panic.
The framework provides a fantastic behavioral guardrail for this exact person. It's called Target Retirement Funds, or TRFs.
Okay.
It's often called the lazy portfolio, but it's brilliant in its simplicity. You pick a fund labeled with the year you want to retire, say a 2050 fund.
Okay.
When you are far from that date, the fund is heavily weighted in stocks. As you get closer to 2050, the fund automatically, slowly, and systematically sells stocks and buys bonds, adjusting your risk profile for you.
It takes the steering wheel out of your hands so you can't drive the car into a ditch during a panic.
Exactly. You never have to rebalance. You never have to decide when to buy bonds. It is the ultimate set it and forget it vehicle for those who want the simplest possible path.
So we know VTSAX is the engine. We know the allocation strategy. But an engine is completely useless if it's leaking oil. And in the world of wealth accumulation, the biggest, most destructive oil leak is taxes.
The silent killer of returns.
This brings us to the actual execution. Where exactly are we parking this money to shield it from the IRS? We need to talk about buckets.
This is a crucial distinction that trips people up. A 401k, an IRA, a Roth, these are not investments. You don't invest in a 401k. They are just tax-advantaged buckets. They are containers. The investment is the VTSAX water you pour inside the bucket, and the government has very specific rules about how these buckets are taxed, which dictates a strict hierarchy of how we should fill them.
Let's walk through this hierarchy. Step 1. You fund your employer 401k up to the match. We see highly educated, high-income professionals ignore this constantly out of sheer inertia. They just never get around to setting it up with HR.
Which is mathematically tragic. An employer match is the only legal guaranteed 100% return in the financial world.
It's free money.
Literally free money. If your employer offers a 4% match and you contribute 4%, they double your money instantly. If you don't take it, you are literally volunteering for a pay cut.
Okay, step 2. After capturing the match, you look at individual retirement accounts, IRAs. You fully fund a Roth IRA if you are currently in a lower tax bracket, or a traditional IRA if you are in your peak earning years and need the immediate tax deduction.
Right.
Step 3. You go back to the employer 401k and maximize contributions up to the IRS legal limit.
Yep.
And step 4, once all tax-advantaged space is exhausted, any remaining surplus goes into a standard taxable brokerage account.
It seems like a lot to journal, but the book grounds this with an incredibly realistic case study. It looks at a 26-year-old earning $35,000 a year.
So what does this all mean for that person?
Well, 35 grand is a very modest salary in the US, but globally, it puts this individual in the top 0.81% of earners.
Oh, wow.
By keeping expenses aggressively low and following this bucket hierarchy, this individual can amass immense wealth over a few decades, almost entirely shielded from taxes.
But there is a trap hidden at the end of this tax-deferred rainbow. If you follow this path perfectly, you maximize your traditional 401k, traditional IRA every year. They grow tax-free for 40 years, and you end up with millions in those buckets. What is the catch?
The catch is required minimum distributions, or RMDs.
Okay, break this down for us.
The government allowed you to defer those taxes, but they didn't forgive them. They eventually want their cut. Currently, once you hit your early 70s, the IRS forces you to start withdrawing a certain percentage of those traditional accounts every single year, whether you need the money to live on or not.
Wait, really?
Yes. If you have been highly successful and have $3 million in a traditional 401k, that forced withdrawal could easily be over $100,000 a year of taxable income.
That's a huge tax bill.
It can push you into a massive tax bracket, subject your Social Security to taxation, and trigger Medicare premium surcharges.
So you essentially get penalized by the tax code for being too successful at saving.
In a way, yes. This is why having capital spread across different tax buckets is so vital for the preservation phase.
To give yourself options.
Exactly. If you have money in a taxable account, a tax-deferred traditional account, and a tax-free Roth account, you have incredible flexibility. In retirement, you can carefully engineer your withdrawals from different buckets each year to keep your taxable income exactly where you want it.
And speaking of specialized buckets, we have to mention the absolute stealth weapon of the tax code, the health savings account, or HSA.
It is the single most powerful tax-advantaged account in America, provided you are eligible through a high-deductible health plan. It is uniquely triple tax-advantaged.
Triple?
Yes. The money goes in tax-free, it grows tax-free, and as long as it is used for medical expenses, it comes out tax-free.
But the real hack isn't using it to pay for this year's dental cleaning.
Exactly. The advanced strategy is to fully fund the HSA, invest that money in VTSAX, and then pay for your current medical expenses out of your normal cash flow. You keep the receipts.
Right.
The HSA money sits there, compounding tax-free for decades. When you are 65 and need capital, you can reimburse yourself for decades of past medical expenses, pulling the compounded growth out entirely tax-free. It acts as a supercharged shadow retirement account.
I love that strategy. But I want to circle back to the corporate 401k. If I have a great 401k at my job, why shouldn't I just keep my money in a 401k forever? Even if I change jobs, it's easier just to leave it where it is, right? Inertia is powerful.
Inertia is expensive.
Yeah.
The text describes many corporate 401k plans as hidden fee cesspools.
Ooh.
Remember, your employer often doesn't want to pay the administrative cost to run the plan, so the financial firm running it extracts their fees from the investment options offered to the employees.
So you're paying for it.
Yes, you might be forced to choose between actively managed funds charging 1% or 1.5% expense ratios.
So what's the move?
The general rule of thumb is, the moment you sever employment with a company, you immediately execute a direct rollover of that 401k into a personal Vanguard IRA. You instantly regain total control, you cut the administrative fees to near zero, and you have unrestricted access to low-cost index funds.
Okay, so let's zoom out and look at the end game. We've optimized the buckets, we've slashed the fees, we've embraced the volatility of VTSAX. We are saving 50% of our income. How do we actually know when we cross the finish line? When do you transition from accumulating to preserving?
This brings us to the cornerstone metric of the FIRE movement, the 4% rule.
Okay, the Holy Grail.
This rule is derived from the famous Trinity study conducted by professors at Trinity University. They ran historical simulations looking at the worst economic periods in U.S. history, the Great Depression, the stagflation of the 70s.
Really stress testing it.
Exactly. They wanted to find the maximum percentage a retiree could withdraw from their portfolio, adjust for inflation every year, and still have a statistical near certainty of not running out of money over a 30-year period.
And that safe withdrawal rate landed at 4%, which gives us a very simple math equation to find our FI number, our financial independence number. You simply take your annual living expenses and multiply by 25.
Let's run the math. If you determine that you can live a very comfortable, happy life on $40,000 a year, you multiply that by 25, you need a portfolio of $1 million.
Okay.
Once you cross that threshold, you are mathematically free. You can withdraw 4%, so $40,000 year one, adjust it for inflation in year two, and historically, the compounding growth of the remaining 96% of the portfolio will outpace your withdrawals.
This math completely reframes how we view spending, because every dollar of lifestyle inflation requires $25 of capital to support it. The book uses Mike Tyson as a brilliant, extreme example of this.
The Tyson example is perfect.
Tyson earned hundreds of millions in his career, but he was famously burning through $400,000 a month at his peak.
Unbelievable burn rate.
That is $4.8 million a year in expenses. To be financially independent at that burn rate, using the 4% rule, he would need an invested portfolio of $120 million.
Right.
But if you can engineer a life where you are deeply fulfilled on $40,000 a year, you only need $1 million. Financial independence isn't just a math problem about growing your wealth. It is a psychological battle about controlling your desires.
It perfectly mirrors the monk and the minister parable from the beginning.
It really does.
The minister needs $120 million to support the robes and the banquets. The monk needs a fraction of that to achieve the exact same level of freedom.
But we have to talk about the silent killer of the 4% rule. This is the math that I think people consistently fail to grasp regarding financial advisors and assets under management fees.
It is the most devastating math in personal finance.
Walk us through it.
Let's say you hire a traditional wealth manager who charges a standard 1% fee on your assets. Most people think 1% is nothing. I keep 99%. That's a great deal for professional advice.
Sounds reasonable.
But you have to look at the math from the perspective of the withdrawal phase. If you are living by the 4% rule, your entire income for the year is 4% of your portfolio. If the advisor is taking 1% of the total portfolio, they're extracting 25% of your annual income.
A quarter of your livelihood. Just gone.
Exactly. You take 100% of the risk, you provided 100% of the capital, and they take 25% of the yield every single year, regardless of market performance.
That is sickening when you put it like that.
The text references research by retirement expert Wade Pfau, who modeled the impact of these fees on the Trinity Study's success rates. If you manage it yourself with index funds, the historical success rate of a 4% withdrawal over 30 years is around 96%.
Okay, very safe.
If you introduce a 1% advisor fee, that success rate drops to 84%. If you are in expensive mutual funds and paying a 2% fee, the success rate plunges to 65%. A 2% fee doesn't just lower your balance, it statistically threatens your ability to survive retirement without running out of money.
Which proves the initial thesis. Complexity is incredibly profitable for Wall Street and potentially fatal for you. But let's look at the rigidity of the 4% rule itself. Is it a law of physics? If the market drops 40% in year 2 of your retirement, do you blindly withdraw exactly 4% plus inflation like an unthinking robot?
No, and this raises an important question about sequence of returns risk. If you suffer a massive market crash early in your retirement, pulling out a rigid 4% requires selling a huge number of shares at rock-bottom prices, permanently damaging the portfolio's ability to recover.
So you have to be flexible.
The key to true security isn't a rigid algorithm, it's flexibility. Collins argues for a dynamic approach. In a severe bear market, you tighten the belt. You don't take the European vacation, you withdraw 3%. In a roaring bull market where your portfolio's up 20%, maybe you withdraw 5% and remodel the kitchen. You use common sense to protect the principal during the lean years.
And as a safety net, what about Social Security? We hear constantly from politicians and pundits that the system is bankrupt, that millennials and Gen Z will never see a dime. Should we factor it into our FI number?
The advice is to treat it as icing on the cake. Build your FI number entirely independently of government assistance. However, the idea that Social Security will go to absolute zero is a misunderstanding of political reality.
Right.
As the text points out, the elderly are the most consistent, powerful voting bloc in the United States, mobilized by organizations like the AARP. No politician who wants to remain in office is going to completely eliminate a program that their most active voters rely on.
It's political suicide.
What is highly likely, however, is that for younger generations, the math will be adjusted. The full retirement age will likely be pushed into the early 70s. Benefits may be means tested, or the taxation on benefits will increase. It won't disappear, but it will be diluted.
So we assume zero, and if a check shows up when we're 70, it's a bonus. But I want to pose the ultimate pushback, the existential fear that keeps people in cash or gold. What if the 4% rule fails because we hit a 25-year economic depression? What if the whole system just collapses?
The doomsday scenario. And Collins addresses this with a very blunt reality check. If the entire United States economic system collapses and fails to recover for a quarter of a century, no financial strategy is going to save you.
Right.
Your stock portfolio will be worthless, but so will the cash in your bank account, and so will the bonds. In a true apocalyptic scenario, you don't need a wealth manager. You need arable land, canned goods, and a shotgun.
Yeah, you're playing a different game at that point.
Yeah. But historically, betting on the end of the world is the worst bet you can make. The market has survived 2 world wars, a Great Depression, presidential assassinations, and global pandemics, because human beings fundamentally wake up every day trying to improve their situation, innovate, and create value. The market is just a reflection of that relentless human drive.
Which brings us to the ultimate synthesis of everything we've unpacked today. True wealth isn't complicated. It requires discipline, the discipline to resist lifestyle inflation and save 50% of your income. It requires a firm intellectual rejection of Wall Street's fear-mongering and deliberate complexity. And it requires the immense, quiet patience to just sit on your hands and let the American economic engine do the heavy compounding lifting for you over decades.
It is the ultimate test of mastering your own psychology. At the end of the day, investing isn't about outsmarting the market. It's about outsmarting your own instincts. In the afterword of the book, there's a quote from Jack Canfield that I think perfectly encapsulates the entire journey. Everything you want is on the other side of fear.
We spend so much of our lives letting fear dictate our financial reality. We fear market crashes. We stress over macroeconomic downturns. We worry about picking the wrong stock or missing the next big tech boom. We seek safety in cash, in complex products, and working just one more year to build a slightly larger safety net.
But this entire framework asks us to redefine what risk actually is. We think the risk is losing 20% in a bear market. But what if the greatest risk is playing it so safe? Keeping your money in a savings account, losing to inflation, buying the luxury car to project status, carrying the mortgage into your 60s, that you never actually acquire the only asset that truly matters.
The total ownership of your own time. If having a surplus of capital, that FU money, gives you the ultimate leverage to say no to a toxic boss, a bad situation, or a life you don't want, it forces a very profound question. What is it that you are currently too afraid to say yes to? Take a hard, unflinching look at your financial life today. Eliminate the leeches, generate the surplus, and start buying your freedom. Thank you for joining us on this deep dive.